You might be wondering, how bad could a credit downgrade really be? Well, we've seen this movie before. Back in 2011, Standard & Poor's downgraded the U.S. credit rating for the first time in history, and the very next trading day, the S&P 500 dropped a jaw-dropping 6.5%, now known as Black Monday. If you want to get our stock and options trades in real time every day, visit our Patreon page to add your email to our real-time trade alerts roster. That wasn't just a one-day event. The market entered a short-lived bear market, falling over 21% from May to October. But here's the twist. Just 6 months after the downgrade, the S&P 500 was up 12%, and a year later, it had recovered 16%. In this video, we'll break down the PLTR chart, identify the key levels, and walk through exactly what I'm watching when markets open. And hey, if you appreciate this type of level-headed analysis when things get messy, hit that like button and subscribe. What does that mean for us now? Moody's just made a similar move, downgrading the U.S. credit outlook, citing surging debt, fiscal gridlock, and rising interest payments. According to their projections, debt to GDP is expected to rise from 100% today to 118% by 2035, surpassing post-WW2 highs. And policy uncertainty isn't helping either, with tax cut extensions, stimulus spending, and entitlement obligations all inflating the risk picture. But despite the downgrade, Moody's did affirm a stable outlook, pointing to the U.S. dollar's reserve status and the Fed's independence as key credit strengths. In other words, it's a warning, not a collapse. And for traders, that means opportunity if you know your levels. Palantir stock just had a strong close Friday, but then after hours hit. PLTR dropped 3% and it wasn't alone. The entire market got hit after Moody's downgraded the U.S. credit outlook, and SPY dropped over 1% after hours. So the big question heading into Monday, is this a dip to buy, or the start of something much worse? While the Moody's downgrade may not guarantee a repeat of 2011, the chart structure suggests it's wise to prepare for downside risk. For SPY, the first key buy the dip zone is around 582, aligning with the rising 20-day moving average, a level that has historically attracted institutional support. If that level breaks, the next high-probability bounce zone sits at 573 to 575, which coincides with a 30-minute pivot cluster and the neckline of a recently invalidated double bottom pattern. Below that, 568 becomes critical. Not only was it last month's floor, but a break beneath it could accelerate downside momentum and confirm a short-term bearish trend. Upside targets remain at 594, then 600. But bulls need to defend 582 to keep that scenario in play. For PLTR, price is now hovering just above 2120, a level that previously acted as resistance before the breakout. A retracement toward the 20 to 2030 range could offer a compelling risk-reward setup for bulls, particularly given the strong volume that accompanied the prior move higher. Should PLTR fail to hold 20, there's a chance we revisit the gap zone around 1890, which also aligns with the 50-day moving average, a level that could attract swing buyers. Targets to the upside remain at 2340, then 2480 if momentum returns. Now, how long could a short-term bear phase last if triggered? Historically, post-downgrade corrections like in 2011 lasted about 2 to 3 months, with the S&P 500 declining over 20% before stabilizing. If today's volatility follows a similar trajectory, a 3 to 6 week correction is not out of the question, especially if macro data weakens or credit conditions tighten. Whether we retest last month's lows around SPY 568 will depend largely on whether institutions treat this sell-off as a dip buying opportunity or the beginning of broader risk-off positioning. On Friday, PLTR closed at 129.52, up 1%, continuing its breakout trend. But now it's trading around 125.60 after hours, and suddenly, this breakout is being tested. Still, the daily chart structure looks solid, Price is holding above the 21-day EMA at 122.66, and volume remains strong. The MACD is rising, the RSI is at 66, and momentum is still bullish. For now, let's talk about what caused the sudden drop. We've been to this rodeo before, and if you want to get our stock and options trades in real time, every day, visit our Patreon page to add your email to our real-time trade alerts roster. This is the first real shake in weeks, and the question is, do we panic or prepare? Here's where things get actionable. For PLTR, first support, 122.66, 21 EMA. Next, 116.88, prior breakout zone. Bigger dip by 110, confluence of moving average plus structure. 4 SPY. Key after-hours support is 588.50, first dip by 585. 36, stretch zone 577. 83, full gap fill magnet 564. If the market flushes, these are the spots where smart money may start stepping in. Let's get tactical. Bullish above 130. Targets 136 and 153. Bearish below 122 to watch for 116 or even 110. If price just hovers inside 122 to 130, wait. Let the dust settle before jumping in. Monday's open is going to be wild. Expect volatility to spike. You'll see overreactions, gap downs, fakeouts, stop hunts. The key is to let the open shake out and wait for confirmation before you act. Traders may start pricing in the idea that a credit downgrade adds pressure on the Fed to cut rates sooner, which could turn into a tailwind by mid-week if dip buyers step in. If this video helped clarify what's happening and how to approach it, smash that like button and subscribe. And if you want real-time updates and setups during market hours, check the pinned comment below. This week could be messy, but messy markets create massive opportunity. Stay focused, don't get emotional, and remember, the best trades often come after the panic.